Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. The global energy map is shifting quickly. Many countries, both developed and developing, are moving away from coal. This change is happening fast, and we expect to see major progress by 2025. This means investing in coal mining companies in these regions comes with growing risks. Ignoring these shifts can have significant financial and environmental consequences. Companies tied to outdated energy sources face declining demand and stricter regulations. This video will help you understand why certain coal mining investments should be avoided. We'll highlight the key reasons and red flags to look out for. The global shift away from coal, a losing bet. The world is rapidly moving away from coal. This powerful trend toward decarbonization and renewable energy sources is reshaping investment landscapes. International agreements, such as the Paris Agreement, along with national policies, are actively discouraging the production and consumption of coal. This makes coal a declining industry in many key regions. This push creates a difficult environment for coal mining companies. Their assets, including vast coal reserves, risk becoming stranded assets, meaning they will never be mined due to changing market conditions and regulations. Government policies and regulations accelerating the decline. Governments worldwide are implementing policies that speed up the shift away from coal. These initiatives include carbon pricing, stricter environmental standards, and subsidies for renewable energy. These measures make coal power more expensive and less competitive. Consider these examples of governmental actions. European Union. The EU has ambitious climate targets. Its emissions trading system, ETS, places a cost on carbon emissions, directly impacting coal-fired power plants. Many EU countries are setting firm deadlines to phase out coal entirely. For example, countries like Germany are actively decommissioning coal plants and investing heavily in alternatives. United States. While policies can shift, the long-term trend favors renewables. Many states are implementing Renewable Portfolio Standards, RPS, which require utilities to source a certain percentage of their electricity from renewable sources. This reduces demand for coal. Federal tax credits for solar and wind energy also make these options more attractive. Parts of Asia. Even in regions historically reliant on coal, change is happening. Countries like South Korea and Japan are investing in cleaner energy technologies and setting targets to reduce coal dependence. While some Asian nations still build coal plants, the global financial institutions often hesitate to fund these projects. This makes securing capital much harder. These governmental pressures create a difficult future for coal companies. They face rising operating costs and a shrinking market for their product. The rise of renewable energy and its economic advantage. Renewable energy sources, particularly solar and wind, are no longer just environmentally friendly options. They are now economically superior to coal in many cases. The cost of generating electricity from solar and wind has fallen dramatically over the past decade. This makes new renewable projects cheaper than operating old coal power plants, even without subsidies. Here's why this matters for coal. Cost parity. In many regions, building new solar or wind farms is less expensive than building new coal plants. In some cases, it's even cheaper to build new renewables than to continue running existing coal plants. This is a critical turning point. Investment surge. Global investment in renewable energy infrastructure is growing rapidly. We see massive projects for solar farms, wind parks, and battery storage coming online. This expanding capacity directly reduces the need for electricity generated from coal. Technological advancements. Ongoing improvements in solar panel efficiency, wind turbine technology, and battery storage solutions further enhance the economic viability of renewables. These advancements mean more power can be generated and stored at lower costs. This economic shift is undeniable. As renewable energy becomes the default choice for new power generation, the market for coal will continue to shrink. This makes coal mining a progressively weaker investment as we approach 2025. Financial risks. Why coal companies are poor investments in phasing out regions. Investing in coal companies, especially in areas moving away from fossil fuels, carries significant financial risks. These aren't just minor bumps in the road. We are talking about fundamental problems that can sink an investment. Let's look at why these companies are becoming increasingly risky choices for your portfolio. Decreased demand and falling prices. The biggest challenge for coal mining companies is the shrinking market for their product. As more countries turn to renewable energy, the demand for coal to generate electricity drops sharply. Think about it. If fewer power plants need coal, what happens to the companies mining it? Their revenues take a direct hit. This decline in demand is also pushing global coal prices downward. When there is too much supply and not enough buyers, prices fall. This creates a tough environment for coal companies, especially those operating in markets committed to moving away from fossil fuels. It is a simple equation. Less demand equals less profit. High operating costs and environmental liabilities. Coal mining is expensive, and it gets more so every year. Miners face not only the high day-to-day costs of extraction but also significant environmental liabilities. Governments are implementing stricter environmental regulations and introducing carbon taxes. These measures increase the cost of doing business for coal companies. Then there are the long-term costs. Mine sites need extensive cleanup and reclamation once operations stop. These are massive expenses that cut directly into profit margins and create financial burdens lasting decades. As an investor, these costs become your burden too. It makes you wonder, are these companies really a good long-term bet? As demand declines and regulations tighten, these stocks could continue to underperform. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.